Welcome, everyone. This morning, IBA is pleased that you're here and you've joined us for this session. Through our national affiliates, we have some really excellent resources available to us. And so I hope you are as excited as we are to have Kai Lynch Sparks with the American Bankers Association here with us today to talk about an issue that is just very top of mind, certainly in my space, in the policy space, in Washington, D.C., but also something that we want our banks to be thinking about and ready for as the kind of deposit and transaction landscape is changing, which are stablecoins and tokenized deposits. So, with that, Kai, I'm going to hand it over to you and let you kind of introduce yourself, and we'll go from here.
All right, thanks so much. As a reminder, you guys can feel free to ask questions in the chat throughout, and then we will cover at the end. We will 100% be sending the slide deck out afterwards, and as Stacey said, it will be recorded as well. So I'm Kai Lynch Sparks. I'm an attorney with ABA, and I work on a really fun team at ABA called the Advocacy and Innovation Team. And what do we do? So my team is split up. There's five of us. You might know some of the people on my team: Brooke Ibarra, Ryan Jackson, Ryan Miller, and I. We have an open slot if anyone's looking for a job. But we're half MBAs and half attorneys. And why does our degree matter? It's because our team really, our job is to look at innovative technology as banks and help bankers understand the business strategy of how to implement those technologies, and then also that risk mitigation compliance framework piece. So the attorneys, including me, work on the advocacy and risk mitigation, and the MBAs work on the strategy. And right now, with digital assets, stablecoin, tokenized deposits, we have an intersection of that. And in other areas, we have an intersection as well when you think about AI, 1033, and open banking, privacy. There's a lot of stuff we have our hands in. And of course, those integrate to other areas of the bank, and we work across departments and teams to work with other subject matter experts to problem solve for banks in our industry. So with that framework of my background and what our team does, I'll start off the presentation. So we're going to focus today on stablecoins and tokenized deposits and what I'm calling the future money. There we go. All right, so we'll kick it off. We'll talk about why tokenization and blockchain matters. When you hear me talk about tokenization, I'm really just talking about the representation of assets on a blockchain. Then we'll go in a layer deeper and talk about tokenized money, what stablecoins and tokenized deposits. We'll talk about regulations, risk, and controls. We're going to cover that on a very high level because that's in flux right now. And then we'll do a little bit of a deep dive on strategic considerations for banks. And so let's talk kind of a broad overview. So tokenization and blockchain infrastructure are really becoming lasting parts of the financial services landscape. Adoption, it will move likely at different speeds depending on use case, geography, client need, but overall, a clear direction towards blockchain infrastructure has become clear. The ability to move money and assets on chain in a way that's secure and compliant is quickly thing that banks need to really understand and prepare for. And I'll dive down into all those subjects. So we don't really see this as a short-term race against a clock. We really want to think about blockchain, stablecoins, and tokenized deposits as really strategic infrastructure decisions for a bank. Banks that start considering connectivity and operational impacts now will be in a stronger position to really understand how their bank will work as client demand grows and as regulations become clearer and as market standards start to take shape. So I think it's important right now for banks to kind of decide or think about how they want to engage in tokenized money. Tokenized deposits will go deeper into this, but they fit more naturally into the long-term structure of the banking system. Payment stablecoins, on the other hand, are already providing really useful or have use cases in certain B2B transactions and treasury payment flows. Both matter and they serve different purposes evaluated accordingly, and we'll talk about that. On the slide here, you'll see kind of the digital asset world. We're gonna focus today on stablecoins and tokenized deposits. We're not gonna talk about Bitcoin. We're not gonna talk about meme coins. We're not gonna talk about NFTs. You can forget about those. Those are digital assets that fluctuate, that if you're really into them, you would probably already know about them right now. What we're talking about is banking infrastructure and what the future of banking will look like and the future of money looks like. We're not talking about assets that change value frequently. So why does tokenization matter? Tokenization, as I've said, is about infrastructure, not specific types of digital assets. By building core capabilities at our bank now, we can really maintain flexibility and long-term relevance. So I've said tokenization a lot. What do I mean? So everything listed here in these categories can be tokenized. And tokenization is a of assets or money on a blockchain or a distributed ledger. I'll kind of go into what a blockchain is in a second, but hold on, please. So each token really represents a claim, a unit of value, or an ownership right that can be transferred, tracked, and verified transparently across a distributed ledger. So in banking, tokenization really is primarily focused on money. We're talking about stablecoins and tokenized deposits. But as you might have heard from the headlines, it also has been extended to securities. NASDAQ and SEC are looking at tokenized securities, commodities, and real world assets. If you want to think about tokenized money and tokenization, you should think about it in term and payments as like the mail. So we're essentially going from physical mail when it comes to money to email when it comes to speed right now. So I'll go into that a little bit later. Tokenization enables instant settlement and programmability of money. And we're going to talk about that evolution now. So what's the hype? Anything that can be tokenized, whether or not, and I say that broadly because you might hear about people, you can tokenize a car title, you can tokenize your wine collection, you can tokenize your art collection. They all share these common assets. We're going to be focusing primarily, again, remember, we'll have a whole section on tokenized deposits and stable coins, but all of these share kind of the same hype cycle. The first is instant settlement and liquidity efficiency. So tokenized money enables instant settlement. It really removes layers of reconciliation, pre-funding, and delayed finality that currently exists in today's payment rails. The result we want to focus on is capital efficiency. So when funds move, when the transaction occurs, happening within minutes, within hours, not days later. For when it comes to commerce, trading, and treasury operations, this really matters because your liquidity is trapped within a system and it can't be deployed or earn interest. And what do I mean by that? Oh, okay. So you're Walmart, right? You're a multi-billion-dollar corporation and you're moving money, whether you're paying suppliers or you're just moving money across your international treasuries. I'm Walmart. I want to move my money to Kenya because like we need to fund payroll in Kenya. And that payroll is $200 million. So I'm moving my payroll money from 200 million in US to Kenya. In a normal circumstance, that would take a week. And there's a person in Walmart whose job is to track where that money is within the system. And while that money is moving through the system, through the rails, it can't earn money. Sitting in T-bills and earning 5% interest or whatever the interest rate of the day is. And when it comes to $200 million, that's a lot of money at Walmart that they can no longer earn. So now if Walmart, if they're working with JP Morgan, they can tokenize that and either move it through a deposit or through a stable coin, and they can move that money instantly in minutes to Walmart Kenya, and they have earned money. in the process instead of in 3 days. And they actually have, it's easier for them to know where their money is. So that's kind of what we think about large scales of money and a use case that we see frequently or um, occurring right now. So that's why the instant settlement and liquid efficiency is really important, particularly when you're talking about big chunks of money moving cross border. Also, I mean, if I'm trying to pay my family in Kenya, maybe I'm earning money. Ignore the fact that I don't look like I'm Kenyan. Earning money, and I'm paying my family back in Kenya. I can give my mom money instantly rather than it taking days for her to get it. So there's value here in not only the speed, but it's also predictability, control, and the use of capital. Another thing that is very important about money that is tokenized, whether it be stablecoin or tokenized deposits, it can be programmed. So it can carry data, rules, and conditions with it. So, for example, I'm Walmart again. I'm actually getting widgets delivered from Kenya. Once those widgets, I scan them into my loading dock in Walmart, Arkansas. Um, the scanner approves and notes that it is the widgets that I ordered. It's tied to a bank account, and an invoice number. All that data is wrapped in with that QR code or scanning code. And then it sends a message to my system that the money needs to be pushed out to that supplier immediately. So without doing anything, with just a scanner, I've got all the information supplier and all that money is sent instantly. Again, the supplier is not having to wait days for that money. So in this model, the payment isn't merely just transferred, it's governed by an action, which is the item was received, and then it's integrated into the business system, it's integrated into the account flow. And so all that money has all the data and programming wired into it and into its systems. All of this said, that use case is very early, but it's a very big future use case that we're seeing. Also want to flag that that's going to be create operational and governance risks, but again, that's what we're seeing. Accessibility. A big one here is that tokenized money really lowers barriers to participation. For businesses and individuals, it can provide access to US dollar backed value without requiring integration into the traditional banking system. This has really big implications on localities where there's high currency volatility, capital control, banking infrastructure. So it's not primarily about replacing banks, it's about expanding reach and reducing friction where traditional systems just don't exist or are slow. And so I'll give you an example. Nigeria. There's 200 million people in Nigeria. The card penetration rate in Nigeria is around 3%. The smartphone penetration rate in Nigeria, they rely on satellites, is 50% and climbing. Stablecoins there aren't disrupting cards, they're arriving first. So if you have a smartphone, you can now transact through stablecoin. You don't have a card. You're using an app to send stablecoin back and forth within Nigeria today. So the last and another future use case is new types of collateral. Um, so when tokenization also changes how assets can be used. So when assets are represented on chain, pledged, and even released programmatically. So this opens the door for new forms of collateral management, faster margining, and really efficient use of assets. For example, again, I could take my wine or let's say my art collection, custody it with a bank, digitalize it, put it on the blockchain, and then offer it to collateral to different banks for different loans. We're not seeing that today, but these are examples of where this is going. So what's driving tokenization momentum? We're seeing increased regulatory clarity. I'm sure everyone has heard Genius Act, Genius Act, Genius Act, maybe a little bit of market structure. So we're seeing a lot of that happen right now around tokenized money, which is stable coins. There's also maturing enterprise grade blockchain platforms that are suited to new regulatory environments. People are building, or entities are building software with banks in mind to use. We're increased and traction. Clients, particularly major, large clients of big banks, are starting to see a huge interest in settlement window, settlement, faster settlement and improved liquidity. There's also ongoing pressure to reduce costs and friction when it comes to cross-border payments. And there's competitive movement. I mean, the GSIBs are live with this right now, JP Morgan, Citi, and also there's competition right now from non-bank platforms, and you'll hear me talk a little bit about that. So I've alluded a little bit to tokenized infrastructure, and I'll give you a peek behind the curtain. And I asked AI to break down for me like the difference between current banking today and what happens when it moves onto blockchain for a high schooler. And it gave me the analogy of passing notes. And I was like, actually, this is kind of cute and great. So bear I run through this analogy. So today, most money systems work by sending messages back and forth. It's like one bank sending a note to another bank that says, please move this money. And then everyone checks and rechecks to make sure that it happens. However, now with blockchain and shared ledgers, like everyone can see, the money itself lives on a shared record that everyone can see. The money moves, the record updates instantly for everyone. There's no passing notes around. The money just changes hands directly. Okay. So, because the money lives on a shared record, it can move anywhere in the world very quickly. And it can even be used or a promise or a guarantee without waiting days for the system to catch up. So the shared ledger is kind of like a notebook that many people can see, but no one can secretly change. So there's special digital locks, that's cryptography, and keys for wallets that make sure that the right person can move the money. There's also built-in rules where everyone happened, so banks don't have to double check each other afterwards. Um, so let's talk about a real world scenario. And I've kind of alluded to this already. So it really illustrates kind of the friction that we have now in the current system. So here we have a major coffee chain. They need to buy beans, and therefore they need to move $1 million overseas on Saturday night. But today's bank rails can't settle that transaction until Monday. So you've got batch processing, weekend closures, legacy infrastructure. Banks face a ton of cross-border friction, multi-step settlement chains, and operational delays. However, client expectations have shifted. Corporate clients are looking for increased speed and global settlement capabilities that are instant, and people are stepping into the space to make that happen. So this scenario really demonstrates the gap between current banking capabilities and digital native scenarios. So it really underscores the value proposition of tokenized money and digital assets. So as the rails and the money can move on chain globally, so does the money move on real time. Non-bank players are already building capabilities in this space. Coinbase is an example, and they're pressuring banks to determine basically how and if they will participate. So let's see. So it's not a theoretical scenario. This is happening today. So what I want you all to think about is, whether your customers need real-time liquidity and how you would be able to deliver it, and if stable coins and tokenized deposits could fit into a future payment strategy for any of your clients. So I've kind of done this pie in the sky. This is the value of this, and I recognize that some of these values are niche, right? Like not everyone has a Walmart as a client. At their bank. But we are seeing border payment, consumer to consumer or B2B, and a lot of businesses are, paying suppliers cross border, or they need liquidity fast to pay people in locally or domestically as well. So stablecoins, tokenized deposits, they're not without their challenges. They aren't perfect technology. Redemption, that's converting the stablecoin back to traditional money. There can be a delay there. It's important to have interoperability across the system. That's blockchain to blockchain, stablecoin to stablecoin. Scalability. Is this technology going to perform well if all the money is flowing through it? integrating with existing systems. The existing banking system's not going anywhere, but we do expect there to be a layer with it, which is the blockchain layer. And how is if it's not going to work, none of this is going to work if they're not talking to each other, right? There's also security risks and vulnerabilities. I get a lot of questions on those. And that's basically system is a target, right? I mean, you see that with ATMs, you see that with a current banking system. Blockchains are designed to be secure, but risks still exist. There's software bugs, human error, compromised credentials. These can all lead to losses. And also, unlike the current banking system, a lot of these mistakes aren't reversible, and the money is moving quickly. So this makes strong security really top of mind. And also, if there's no confidence in this marketplace, there will be no widespread use. So these are real problems that need to be solved that can delay uptake if they're not being solved for. So let's do a deeper dive into payment stablecoins and tokenized deposits. And I'm going to take a deep breath. Y'all, it's a lot to just talk by myself. It's very lonely here, so I can't wait to answer your questions. Um, so we've talked about tokenization generally and alluded to stablecoins and tokenized deposits. A deeper dive. So what's a stablecoin? Um, they're a form of digital assets. They're designed to maintain a stable value because they're pegged to a reference asset like a US dollar, in our case. So just think of it as the representation of a dollar on the blockchain. What makes it stable is that issuers, which is typically Tether or Circle are the biggest stablecoin issuers. So if you hear Tether or Circle, that's what you should think of. They issue stablecoins, and what they do is they hold reserves. These reserves, required by Genius, have to be cash deposits, short-term or short-term treasuries, or a few other things. But they're designed to ensure that every token can be deemed one-to-one for its underlying fiat value. So here's the core flow, this picture at the bottom. You have the reserve, and those are where the assets are held. These are custodied typically with a bank. Caveat here, you're seeing a lot of stablecoin issuers going after trust charters. Why are they going after trust charters? Because they want to custody their own reserves and make money on those reserves. So that's a little bit of friction here. So stablecoin issuers now, if they want to become a trust bank, can custody their own reserves. If not, they partner with a bank. Circle partners with BNY to hold its reserves. They they So the reserve is kind of the core of the stablecoin's credibility. The stablecoins are distributed from an issuer to an exchange and then to customers through a wallet, which kind of serves as their account on the exchange. Finally, banks, as I mentioned, can play several roles. They can custody the reserve, or they can work as the on and off ramp, exchanging that stablecoin into a dollar. So stablecoin, their business model is a earn money from the interest on the reserves backing the stablecoins, not typically from payments or transaction fees. So while a stablecoin might move fast, the business model is always passive and typically very reliant on how much money they're making in reserve. Here's the market today for stablecoin. They've surpassed 300 billion with an annual growth right now between 40 and 60%. Transaction volume rose to 33 trillion in 2025, and stablecoin issuers are top of the 15 US Treasury holders. So let's move on to tokenized deposits, and then I'll talk a little bit about the differences between them. So tokenized deposits are an on-chain representation of a bank deposit. Just think about your core system is now a blockchain ledger. It's gone through the bank's onboarding and KYC process. It's a direct claim of the issuing bank, and it's eligible for FDIC insurance. And of course, examples are out today. That's Connexus through JP Morgan, Citibank, HSBC. There was also an announcement, with Huntington, M&T, and a bunch of other large regional banks. They're going to go through the carry network and issue their own tokenized deposit. So these should be seen as walled gardens right now. So digital or tokenized deposits can't move from the bank right now, according to the technology that we have today. So when you look at Connexus, Citigroup, HSBC, you're going to think about their Walmart clients, their large clients with international presence that are really interested in moving money cross borders. And that's why JP Morgan, Citi, USBC were kind of first to market there because they saw a real need for clients to have that instant settlement and liquidity. So let's talk about structural differences between the two. Payment stablecoins are typically fully reserved and segregated on the balance sheet, designed primarily for payment, for transfer and settlement, and not credit intermediation. So we're not doing loans on, stablecoin issuers aren't issuing loans on those reserve, they don't function as deposits. So tokenized deposits, on another hand, represent bank deposit liabilities on the bank's ledger. They integrate with balance sheets, they support lending economics, and they qualify for deposit insurance. From a system perspective, tokenized deposits are more aligned with our traditional banking model, and stablecoins kind of emphasize that transactional efficiency. You want to think about stablecoins as money in movement and tokenized deposits as money at rest, right? So there might be a future where a bank has tokenized deposits and is moving money across border, for example, like JP Morgan, or maybe between banks with a tokenized deposit. But if they have a client that wants to move money across borders, they might swap out those tokenized deposit coins and move them cross border. That's kind of the future of what evangelists are predicting. So infrastructure is more developed for stablecoins right now, and really this slide just says what I just said. So sometimes I get ahead of my presentation. So tokenized deposits are just a little bit behind stablecoin. I have conversations with people. They're like, "Are tokenized deposits happening? What's going on?" I'm like, "Listen, there is a vested interest in the banking community to participate in this field, this sector, this growth, this infrastructure." And we're going to see announcements, but again, the market's going to do what the market does. But if there is interest um, in clients and in business to have this work, then we'll see more of this uptake. And I think that that is kind of where the future is going. So let's talk about. I'll cover real quick payments, but I think I've kind of already checked these boxes as I've gone through to give examples. We've talked about cross-border payments and B2B payments. With cross-border payments, I think you really, from like a strategy perspective, correspondent banking is going to face a strong amount of pressure as stablecoins and tokenized deposits take shape. B2B payments, I've given examples of this, but we're really streamlining supply chain finance, instant invoice settlement, and reduce working capital needs. Merchant payments I haven't touched on. These are lower fees than card networks today. Instant settlement with merchants versus 2 to 3 days and no chargebacks. So think about people, having a PYUSD card and tapping it at a merchant instead of going through a debit card or something like that. Visa is all developing and stable coins right now as well. Securities trading, sorry, tokenized securities plus stablecoins equals you're going to be able to sell those securities and get that money instantly in your account. So there's no counterparty risk during settlement, and that provides a lot of use cases. So regulations, risk control, Genius Act. I'm going to be really high level here, and the reason why I'm going to be high level here is because I want you to think about the Genius Act as, all right, I'm not a sports gal. I don't have a favorite sports team, but I like to use sports analogies. Think about the Genius Act as like we have the lines in the field, we have the goalposts, but we don't have the rules of the game yet. And the rules of the game are currently being written. So the Genius Act provides the framework, right? So it sets the rules for the issuers on reserves and disclosures, but we have a huge batch of policy next steps when it comes to the stablecoin. Per Genius Act, have to do rulemakings across 16 distinct areas by July. OCC, as a matter of fact, issued theirs yesterday at around 6 p.m., and I'll be reading that. And that will be one of the first major rulemakings that will put the rules for the game and on the field. So, and those are big rules. So the rules will discuss the application requirements and how they will be approved to issue these stablecoins for potential issuers. They'll evaluate the state level certification regimes, capital liquidity standards, anti-money laundering. So really the whole game for how this technology, how these stablecoins will work. Um, Again, we have one proposed rule that is substantive right now, and it was issued yesterday. So more to come. I think you'll hear a lot about that in the next 2 weeks, I'll say. As far as policy next, talked about Genius Act rulemaking. We expect to see some guidance from federal regulators on tokenized deposits, and then the next push is going to be a market structure statute and subsequent regulations. You might hear about Genius Act. Remember the graph at the beginning that had digital assets, and I said I was going to focus on tokenized deposits and stablecoin. Well, market structure is going to cover the rest of the cryptocurrency world, and Genius Act really only covers stablecoin. So, in order to have a fully functioning system and regulatory and statutory infrastructure for these business entities, we need market structure to pass. We also, as many of you might have heard, are seeking more clarity and some closing of the loopholes for some Genius Act yield issues. So when it comes to risks and controls in this space, really tokenization, blockchain, it just introduces familiar risks in new form, um, faster liquidity and potential run dynamics because money is moving instantly, operational and cybersecurity exposure, including key management. Um, Banks, of course, are going to be working with third parties for this infrastructure, and those dependencies create more checks and balances for banks. And right now, there's compliance and reporting obligations, and those are still being hashed out, as I've said, according to the Genius Act. Risks, I think, are going to be manageable, but it's going to require a lot of work for banks to come up to speed. So let's talk about strategy, which pushes us into the second half of our presentation. If I was doing this in person, I would stop and ask questions because I feel like that part is just so hard because it's like, how does this work and what is the benefit? Now that we kind of have like a 10,000-foot level of like how it works and what's the benefit, let's talk about how banks should strategically be thinking about this. And, if you're a smaller bank, bank, size, it really might depend, right? Build by partner is a phrase that we hear a lot. So let's talk about the market. The market, as I'm sure you have heard, is really saturated with stablecoin announcements, and a lot of it is noise because some people just want to, make an announcement and say that they're playing in the game, even though they don't know what the actual plan is, right? Sometimes it's just a PR move. Customer demand is really limited today. There's a reason why I've only given you a few examples of the use cases, and they're kind of very common and niche use cases, although they're important because we're talking about a lot of money that's moving. Most retail and commercial clients aren't actively requesting stablecoins, right? At the same time, there's pressure here. Non-bank technology firms are building bank-like services using stablecoins and blockchain-based payment rails. And these firms designing products and infrastructure for traditional bank customers. So it really becomes a strategic question of whether banks prepare now or wait for competitive pressure to really dictate that timeline. So this is kind of where we see competition accelerating across the marketplace. We've got payment service providers, and everyone at the bottom, all these logos here, these are people that are actively um, they're either piloting or doing this work now. So payment service providers are capturing cross-border payment and FX spreads. We've got crypto natives like Coinbase, Paxos Circle. They're either issuing stablecoins or they're developing settlement infrastructure that's enabling dollars to move cross-border 24/7, 365. And these guys are really going to be the ones responsible for disintermediating the corresponding banking infrastructure. We have neobanks that are um, enabling retail access to USD banking, and they're embedding stablecoin into their accounts using like API first platforms. There are super apps, and of course, I've already touched on the GSIBs. They're aggressively scaling in this space. So, I've told you about your competition. We've talked about noise. I want to kind of bring this down and like level set a little bit for you. And we have use cases on the left, but really I want you to look at the chart here to see the percentage of use case that's happening. The first is crypto trading on and off ramping. What is that? Great question. These are niche crypto um, traders on the internet who just like to invest in, the Bitcoin, the meme coins, the Doja coins, the Ethereum, who are trading, earning money on those trades, and then they'll off ramp onto a stable because it's quicker, right? And then they'll trade again. So they're just the majority of usage right now for stablecoins is just people on and off ramping their crypto trades. And I want to just drive that in because I know I've talked a lot about pressure here in the marketplace and the importance of this technology. But I also think it's important to say where we are in the use cases. And 92% of people, that's the vast majority, are just using it in crypto trading. And as we know, that's not the majority of bank customers, right? Now, I think you could probably pull your bank data and see who's moving money in and out of, I've been on the phone with a lot of banks and on a lot of big calls, and we had somebody who was like really interested. They're like, yeah, my customers are asking for it. And I was like, who are your customers? It was a bank in Nevada, and their customers were primarily online gamers and crypto traders. And I was like, oh, this makes sense for you. But it's again very niche. Should be at this technology. The next is at 3% real world, tokenized real world settlement. What do we mean by this? This is like settlement of like BlackRock ETFs in crypto. The next is wallet-based transfers and remittances, P2P, payments on-chain spending, and then payments that's exchange, treasury. When I talk about treasury, I don't know. Whenever I talk about finance and banking, I allude it to healthcare. Like it's like saying I'm a nurse or I'm a hospital administrator or I'm a health policy person. Like it's banking is such a big field. So treasury is really just people managing their internal money across borders. So that's again where we're seeing some usage. So that accounts for 100% of where we're seeing stablecoin today. And so to take a little pressure off you, oh, sorry, I'm do this on Zoom. It raises my hand, and I'll fix that later. So just ignore. Just think of it as a high five. So the stablecoin markets, it's immature. And use cases for stablecoins were expected to expand beyond the crypto ecosystem. So let's talk about how we want to think about stablecoin now that I've kind of told you about it, the use cases and level set where we are. I think we should be thinking about stablecoin as just another payment rail. We've got all the payment rails up here that you can see. And whenever you're offering payment rails to your bank customers, you're looking at speed, cost, consumer protection, fraud and scam prevalence. What are the infrastructure requirements? Do your customers need cross-border support? Is it easy to use? Customer interest, rewards and incentives. All these factors go into your play for how to develop a payment strategy, whether your bank or your customer. These are all important factors, and stablecoin offer some real benefits in these, particularly right now when it comes to speed and cost and cross border. Ease of use, though, I'll give you an example. Brooke Ibarra, who is my SVP, I was running to get coffee for myself. I said, "Hey, Brooke, you want some coffee?" Going down to Maman, and she was like, "Yeah, sure." Go downstairs, bring her back coffee, and she was like, "How do I pay you back?" And I joked, I said stablecoin, and she laughed because like in order for me to get a stablecoin, I'd like have to convert my dollars into stablecoin and then like ensure that she could even receive them, which we both have not. I don't have stablecoins lying around, right? Like there's so for ease of use in a P2P space, it's not there yet. JP Morgan Chase, Citi, HSBC, they've built an ease of use platform for their clients with particular needs, but we don't have ease of use yet. So when it comes to payment and competitive dynamics, I think this is helpful to think through. So banks have historical advantages, but they're under pressure from expanded access to payment infrastructure and the growth of non-bank providers. Tokenized payment rails, including stablecoins, they reduce dependence on correspondent bank and legacy clearancing systems. And so when you want to think about exposure by segment, international payments face the most immediate pressure. Then you're going to look at commercial and treasury payments. They're going to see gradual experimentation. And then retail adoption. That's likely going to flow from merchant and enterprise usage. Merchants have a real, particularly small businesses, they want that money instantly, right? Like there's value in that, particularly if they're charged less for the transaction on an interchange rate. So we definitely think we'll see growing retail adoption there. And from a payments piece, you really want to treat it as an actively managed strategic business, not just a static revenue source. So right here, we have a range of options to engage in the tokenized ecosystem. And like I said, if that makes sense for your customers and your business, you can hold reserves for a stablecoin issuer. I have heard stablecoin issuers talk about how they want to work with community banks more. You could issue a fully reserved stablecoin, although I don't think that's a good play. One, because the only way these stablecoin issuers are making money is one, by disintermediating the banking system, but two, by holding their reserves. And the only way to make a ton of money by holding stablecoin reserves is scale. That's why you see two main players, Tether and Circle. Blockchain wallets. This is storing stablecoin or tokenized deposits for your clients. It would look just like, you'd have your checking account, savings account, maybe your stable. Convert fiat on off ramp, swapping out stable coins for dollars, and then tokenized deposits. So how do we prepare for a tokenized future? This, just so you know, this slide comes directly from a board update from ABA. We had a project internally with our economists, our team, and the innovation strategy team, and then some other people on membership. And this is kind of where we settled for where banks should be thinking about this. And we thought offer wallets where you can send, receive, and store stablecoins, tokenized deposits, and other digital assets. Pursue tokenized deposits as a preferred form of tokenized money. Redevelop or reimagine your payment strategies. And most banks, as I've stated, should not be thinking about issuing stablecoins. They should be thinking about this as payment strategy and infrastructure for their clients and tokenized deposits. Think through these scenarios and think through the noise. Let's talk about how to think through the uncertainty. So we really need to zoom out from the headlines today. And at the top, we have some scenarios. You see the extremes from left to right. The first is, your fringe. There's not going to be any mainstream uptake. This is just going to be specific use cases. It's going to stay in crypto world. It's going to stay in treasury management. Um, or all the way on the left, scenario C is everything is tokenized. My house will be tokenized. I can tokenize all my property. The system is largely run by DeFi and non-banks. I don't think that's going anywhere. I don't think our banks are going anywhere. And then scenario B is where there's a world where tokenization provides some optionality depending on a consumer's use case, and tokenization is more integrated into bank services. And so I think scenario of where we've settled as the experts that look at this today at ABA. And then when you think about hmm, the market, I think it's important to look at kind of what's across the board at the bottom here. First, we're waiting for regulatory clarity. Banks have been through it. You guys, we haven't been able to even touch this space until very recently. So, like, don't freak out that you're behind because it's for good reason. You literally weren't able to interact here, and non banks were flourishing in this space while you guys were handcuffed. So we're still waiting on that regulatory clarity. We're expected to get it this year. So stand by. It's important to look at capital flows and strategic commitments. Like, who is Fiserv? Who are your cores partnering with? What are their strategies? And that goes to the infrastructure maturity and integration. A lot of banks are going to be relying on their cores and partnerships with fintechs to get these businesses and strategies up and going. You can't make that your for it to be built and make sense for your strategy. So a lot of this is looking at who you're going to partner with and whether they're ready. I know I talked to Fiserv literally, I think on Monday or Tuesday. Um, and they're still in pilot phase. You can't launch something if your core is in pilot phase. So, but they're getting ready. They're gearing up. So again, with that regulatory clarity, with that infrastructure maturity, you'll see you'll be able to gather your thoughts. Another is, demand for programmable dollars. Are your clients, are your customers looking at this? Demand for developer roles for certain companies. And then lastly is a wild card, right? This could all fall apart if there's a major fraud, right? Or a major failure. It could, like another SVB happens. If JP Morgan's Connexus system crashes or has a major fraud with their stablecoin, that could really stall momentum. And so there's a lot here. So I know I wanted to create both, I hope, a sense of urgency for you guys to really understand the technology and what it could mean so that you can start thinking about a strategy. But I also don't want you to feel like you're behind, right? The market is still immature. We don't have regulatory clarity. We don't have full infrastructure yet, unless you have the ability to build it on your own, which is amazing. I think most people will be partnering with people until they figure it out more. And so those partnerships are going to evolve. So with that, I'll turn it over to you guys for questions. I'm sure you have a lot. There are no dumb questions, by the way. And I might not be able to answer them all because while I know a lot, I don't know everything. So if I don't know, I'll try to get you the answer.
What I think is really amazing is you do know a lot and you are able to break it down. Maybe it is that I need to be talked to like a high schooler, but that was really great. This is a complicated issue, um, and I understand it a lot better than I did 50 minutes ago. Um, Questions. You can put your hand up, you can come off mute, you can type in the chat. I have one that maybe we can start with. What about the stablecoin like market? Stablecoin issuers, so one of our neighbor states has one. Wyoming has a
Oh,
stablecoin. We currently have World Liberty Financial at our state house pitching a bill to allow the state to contract with a stablecoin issuer to pay its vendors in stablecoin, which like per your presentation and everything else feels premature, but that's happening in many states. He said that they're working
right.
in at least 5 or 6 states to get that done. So um, what's happening on the issuer side? Are we going to end up with kind of a ubiquitous coin or many coins, or what do you see in terms of the stable coins themselves?
That's such a good question. And I don't know if I have strong feelings about this. I do think states like the Rough Rider coin and maybe a future Idaho coin. I mean, think states could be earning money on their T-bills instead of it not be, and states operate large budgets. And but at the same time, that's at a cost to their local banks, right? And so, and also, Treasury, the federal Treasury, by the way, U.S. Treasury rather, has a vested interest in people backing these stable coins in U.S. T-bills, right? Because that's good for our dollar and for our national debt, right? So there's a little bit of a friction here in the state or government interest in stable coins, and also banking interest and not disintermediating our banking. So I don't know where that will go, right? But I do see the value in it, right? Whether or not, I think there's a lot of people that think that there's going to be thousands of different stable coins. I don't know if I agree with that. Again, I think there's value where the value primarily lies in scale. However, I do see and have concerns about closed garden systems of stablecoins, and which I kind of put, Wyoming or the Rough Rider coin in that bucket, right? Because they have like a user base in whoever they pay, right? Like people have a vested interest in who they're paying and that money float there. I do worry about, for example, an Amazon coin or a Target coin, and them having like an Amazon debit card that runs um, on stable coins, and they offer a discount to customers for using their Amazon stablecoin. Again, because that's pulling money from bank deposits and into an Amazon system, and Amazon's not issuing loans to community banks and creating economic value locally. They're just padding Amazon wallets. But again, I think Amazon has a vested interest. Now, there are some laws around that, but where there's a will, there's a way. Meta just reported in their investor, I forget what the investor readout is, but they said that one of their priorities this year is exploring a stable coin. So we'll see. To be determined. It's not a great answer, but it's the answer I have.
Nope. This is a very dynamic space, right?
Right,
There's a
right.
lot of unknowns, but and a lot of considerations. So, any questions from participants?
Again, no dumb questions. And I hope I didn't insult anyone by the high school level. It's like I'm not a technologist. I don't know anything about coding. And so it's really challenging to understand some of these concepts, but we do our best.
When people go deep on blockchain, I'm like, nope, I'm not there.
No.
Like, you need to.
I like the word distributed ledger. Like they're actually different technically, but when it comes to money, I think understanding that everyone's working from the same ledger, and distributed ledger is more descriptive of that instead of blockchain. I'm just like blocks in a chain. What does that have to do with anything? All right. Well, while we're waiting, oh wait, oh, thanks, Mike Morrison. These are some of our sources if you need. We're expecting, again, the OCC just put out a Genius Act rulemaking last night. And so that's going to be our big push, is not only understanding, but also we'll be issuing kind of a summary from that. I'm sure Stacy will hear from us. And maybe you all will as well. And again, this space is evolving. I think one of the first steps I think is to take is kind of have a group internally, a working group internally, to kind of analyze whether or not there's a fit for your customers with payments related to stablecoin or tokenized deposits. And like I said, a good strategy is we're going to wait and see. But I think first is understanding the use cases and the growing use cases, tracking the market. What we don't want is more non-bank actors coming in this space, and not bringing money back into our communities. So
That's right. Okay, not hearing any other questions. Last call here. We're 3 minutes shy of 11 o'clock, our hour. Then I'll go ahead and Kai, thank you so much. This has
Yeah.
been, I mean, I feel like with all the conversations going on over at the State House, like everybody could use a Kai in their lives to help them understand this issue when they're contemplating legislation. So, and trying to make business decisions and
Well,
anticipate what's
I'll tell you
coming.
what, gosh, I'm forgetting the Mississippi Gordon.
Yes,
Gordon had me brief some senators, and I did it online, just like this. So if you ever want to get like a small group together to do this again, happy to do it. I can't do 50 of them, but if there's onesie twosie requests, I'm happy to help in any way.
fantastic. Well, on behalf of the Idaho Bankers, thank you so much. And thanks
Thank
everybody for
you.
logging in.